Hey everyone, welcome back to Corporate Dakota, the place where we break down the numbers and give you the real scoop. And today we are diving into a company with a very specific mission statement. Let's just say they are all about emotional wellness through travel. Get ready for Siltrium Tech Corporation's latest 10Q filing. Before we jump in, if you like getting these kinds of unfiltered insights directly from company reports, make sure you are subscribed. And if you want to chat with us and other finance enthusiasts about these filings, join our Discord community. The link is in the description below. So Siltrium Tech Corporation is filing a quarterly report at 10Q, which gives us a look at their performance over the last 3 months, ending the 31st of October 2025. Let's kick things off with a look at the company's financial health on their balance sheet. As of the end of October 2025, Siltrium had total assets of about $88,339. That is a pretty significant jump from the $29,500 they had at the end of July. This increase is largely thanks to a big jump in intangible assets, which went from $29,000 to over $80,000. Now, this might sound like Siltrium is suddenly sitting on a goldmine of intellectual property, but remember, this largely represents their spending on developing their website and their new travel planning tool called Tripweaver. On the other side of the balance sheet, things look a bit more challenging. Their liabilities have also grown quite a bit, jumping from around $26,099 to nearly $129,224. A big chunk of this increase comes from accounts payable, which more than tripled from $5,000 to $18,000, and a related party loan payable, which shot up from around $21,000 to over $111,000. This means the company owes a lot more money to others, and much of that is to someone related to the company, which is a common theme we'll see. So overall, their total liabilities are now more than double their total assets, meaning they have a deficit in their stockholders' equity. This shows a company that is spending heavily on building its platform, but isn't generating any revenue yet. Now let's look at how they did financially over the last 3 months. The most important number here is that for the 3 months ending the 31st of October 2025, revenue was zero. Yes, you heard that right. Zero. They did have operating expenses totaling $44,286. The bulk of this $40,149 falls under general and administrative expenses. This is where they are spending their money on things like software development, paying their auditors and lawyers, and renting servers. They also had an amortization expense of $4,137. Which is basically spreading out the cost of their intangible assets over time. All of this led to a net loss of $44,286 for the quarter. This means their expenses were way higher than any income they brought in, which of course was nothing, and for every share of common stock they have, they lost about 2 cents. This is typical for a development stage company that is investing heavily in its future. Looking at the changes in stockholders' equity, we see that on the 31st of July 2025, they had a small positive equity of $3,401. But after the net loss of $44,286 for the quarter, their total stockholders' equity ended up as a deficit of $40,885 on the 31st of October 2025. This highlights that their accumulated losses are growing and eating away at any initial capital. When we look at their cash flow, it paints a similar picture. For the 3 months ending the 31st of October 2025, they used $34,649 in operating activities. They had that net loss we talked about, but they also saw some changes in their short-term assets and liabilities, like an increase in prepaid expenses and an increase in accounts payable, which helped a little but not enough to stop the cash drain. Their investing activities were even more draining, with $55,500 used for purchasing intangible assets. This is the money they spent on building out their technology platform. The only good news on the cash front comes from their financing activities. They brought in $90,125 through a related party loan. This means someone connected to the company, likely its founder, loaned them money to keep the lights on. This related party loan is becoming a critical lifeline as the company isn't generating any revenue yet. And because they spent more cash than they brought in from operations and investing, their actual cash on hand decreased slightly. They started the period with $500 in cash and ended with $476. This is extremely low and really emphasizes their dependence on that related party loan. So what exactly is Siltrium Tech trying to do? They're a travel technology company focused on emotional wellness and personalized travel. They launched their website siltrium.com, and on the 15th of September they rolled out Tripweaver, an AI-powered travel planner that creates itineraries based on how you want to feel after your trip. They also launched a mindful travel blog. It is a very niche market they are targeting, aiming to combine emotional well-being with travel planning. Now, this is a very important section, the going concern note. They themselves admit that because they have no revenue, a growing accumulated deficit, and very limited working capital, there is substantial doubt about their ability to continue as a going concern. Basically, they are saying they might not be able to stay in business for the next year if they don't get more money. They plan to get this money through further investment in capital markets, but there is no guarantee they will succeed. This is a red flag that investors should always pay attention to. Let's look at those intangible assets again. They've capitalized development costs for their website, their TripWeaver service, and their mindful travel blog. These are all assets that are expected to provide future benefits. However, these costs are being amortized over 3 years, meaning their value is being reduced each year on paper. This note really spells out the reliance on the founder. Mr. Mark Scribble, the president, CEO, and sole director, has loaned the company $111,224 as of the 31st of October 2025. While this loan is non-interest bearing and unsecured, it is crucial to understand that the company's survival is currently tied directly to the willingness of its leader to inject personal funds. This is a risk because ultimately, the founder's personal finances can impact the company. In their management discussion section, they re-emphasize their mission of emotional restoration through travel. They see a big opportunity in the wellness tourism market, which is growing as people focus more on mental health. They believe they fill a gap because traditional travel planning focuses on logistics, not emotional outcomes. Their plan to make money is quite interesting. Initially, users get up to 10 free TripWeaver requests per Dalton Y. After that, it will cost 50 cents per additional request. They also plan for future revenue streams like user-generated itineraries and premium subscriptions. It is a freemium model, typical for many tech startups, but it hinges on attracting enough users to convert to paid services. And speaking of employees, it is worth noting that Siltrium Tech currently has only one employee, who is Mr. Pedro Henrique Marx Fribble, the president, treasurer, secretary, and director. This highlights how lean the operation is right now, with the founder wearing pretty much every single hat. Finally, in their controls and procedures section, they admit that their disclosure controls and procedures were not effective. This means that information required to be disclosed in their reports might not be properly processed or communicated to management in a timely manner. This is another point that suggests the company is still very much in its early stages of development in terms of its corporate governance and internal processes. Now, let's take a moment to step back and look at the bigger picture for Siltrium Tech Corporation. The company is clearly in its nascency, heavily invested in developing a unique platform for emotional wellness through travel. Their strategy of targeting a niche market with AI-powered personalization has potential, especially given the growing interest in wellness tourism. However, the financial reality is stark. They have zero revenue, a significant net loss, and a growing deficit in stockholders' equity. Their cash burn is substantial, and their survival hinges almost entirely on continued funding from their founder through related party loans. The going concern note is not just a formality, it is a flashing red light indicating the high risk associated with investing in this company at this stage. The effectiveness of their disclosure controls also suggests that their internal processes are still under development. While the idea of emotionally restorative travel is appealing, the path to profitability and operational stability is long and fraught with risk. In conclusion, Siltrium Tech Corporation is a high-risk, high-reward venture at this point. The innovative concept could capture a growing market, but the lack of revenue, heavy reliance on founder financing, and operational challenges mean that it will require significant further investment and successful execution to become a viable business. The company's direction is clear in terms of its niche, but its financial foundation is extremely fragile. Alright, that is our breakdown of Siltrium Tech's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.